Good morning. I'm very pleased to say that we are at LGT Wealth Management in London, and with me I have Henry. Henry, do you want to introduce yourself?
Yes, thank you. Hi, I'm Henry Wilson and I work in the LGT Model Portfolio team. I've been in the team for about 7.5 years and seen our assets grow from around 200 million in 2015 time to around 7 billion today. So it's been great to kind of see that evolution of growth.
Fantastic. And Henry looks after our Wealthlineinvest Portfolios, which many of you will be familiar with. And today, really, I'm here to give Henry a good grilling on your behalf, to ask him all the sort of difficult questions I know you'd want to ask. And we'll start off with an easy one, Henry. So, what's going on in the world at the moment that's affecting our portfolios?
I'm not sure if that is an easy one, but no, it's been clearly a year of transition where the previous decade or so of free money, very accommodating monetary policy and low inflation, that is now over. And I think that this year of transition has meant that as investors now realise that the free money era is over, the party is over, that you need a different toolkit and a different investment toolkit for that environment. So this year, where you've had higher inflation caused by not only the COVID disruption, but also caused by the war in Ukraine, has meant that inflation has been higher than anticipated. It's meant that interest rates have gone up higher than anticipated. And bonds have suffered, and also equities have suffered. And in particular, for those investors that have portfolios constructed around those two key asset classes, it's been a very tough year. I think it's been the worst year for a bond equity portfolio since 1931 or 1932.
So that was the easy question. We'll move on to the hard ones now. So, how would you describe our Wealthline portfolios?
So the Wealthline portfolios are constructed around two main kind of managers, as it were. We, LGT, take the overall management of the entire portfolio, but half of it we have elected to use a multi-asset fund manager. And after a period of research, we decided to use the BlackRock MyMaps multi-asset fund range. And so we invest 50% of the portfolio into the BlackRock MyMap range. We have the ability to change that. It's not we're not wedded to BlackRock MyMaps. If they go through a period of underperformance, or we feel that they're no longer able to deliver attractive returns at a good level of risk, we can of course change, and we would do if required. But for the time being, we've chosen to use BlackRock for that kind of half of the sleeve. The other half of the sleeve is very much LGT Wealth's kind of expression of our views and themes and ideas. And so you have quite a nice kind of, I guess, offsetting effect where hopefully if we're wrong about something, as we inevitably will be, we can't get everything right all the time, that perhaps that BlackRock and their expertise on that side will offset any of the losses that we might make with decisions that they make on their side. So it's a bit of a hedging mechanism. And when I say hedging, I don't mean that it's a hedge fund or that it'll be able to produce returns when the markets are down. It's more diversification of views and implementation. We're not always going to be doing the same things. We're not always going to be doing different things, but hopefully it'll balance out our views and produce smooth returns over the long term.
Okay. So you and your team here at LGT are responsible for the actively managed part of that portfolio. How do you go about constructing the portfolios themselves across the different risk ranges?
Yeah, so it's a great question. I think first and foremost, we are fundamental investors. So what's really important to us is analysing the data. What are we seeing in terms of things like valuation, earnings growth generally? Those are all things that go into our thought process. But more importantly, we have what's known as a centralised investment committee. And that investment committee is comprised of around 10 voting members. They each have on average around 25 years of investment experience. And that committee decides the view for the firm in terms of what are our views on all the key asset classes. So are we positive on UK equities? Are we negative on the US? Are we positive about gilts or treasuries? Those types of key decisions. And the decisions are emanated from that investment committee. And the whole idea is that investment managers like myself are informed by the investment committee, and that allows us to ensure that the same themes and ideas are reflected in your portfolios, as other client portfolios, so that you have a consistency of thought, you have this experienced team in the middle, the investment committee, that are emanating key themes, ideas of sectoral kind of investment ideas that all investment managers around the floor can invest into.
Okay. You mentioned themes, and another thing is probably trends. Are you identifying anything in particular at the moment that are very strong trends in the market?
Yeah, so the big trend in the market at the moment in terms of kind of mega trends, long-term trends that might take a number of decades to kind of play out, I can kind of just touch on four perhaps, but it's not limited to just these four. There are so many of them at play. But the first one is clearly to do with the whole rise of impact investing, sustainable investing. It's clear that the world has undergone a change over the last few years, and people are aware that we need to transition to a more clean, kind of green-led economy rather than a carbon-led economy. And to do that, you need to be kind of investing money in these early stage businesses and identifying those businesses who are going to be the winners and those that might be the losers. And so we own a selective bit of exposure in these types of businesses across the portfolios. We recognise that some of the earlier stage investments are clearly more risky, but there is no doubt that there will be more money spent in this space of things like renewable energy, solar panels, wind turbines, technology to help with water cleaning, technology to help with pollution management, water management, all of those types of things to make the world more kind of green, more sustainable. There's going to be a huge ton of money that's spent in that space. The second area, I think, is to do with the rise of Asia. It's a hugely growing part of the world, and if you take China, for example, in the last 40 years, 800 million people have come out of poverty. So that's 800 million people whose main decisions will shift from where they're going to get their next meal to whether they want an iPhone or a Samsung, or whether they want to drink an expensive bottle of cognac or an expensive bottle of red wine. And so that's a really exciting trend, and that's one that's not going to go away. I think the third mega trend that comes to mind would be the rise of middle classes just generally. We've seen it in Europe and we've seen it in China, but it's not just a phenomenon that will impact China. It'll impact also Africa, other parts of emerging markets like Latin America, emerging Europe. We will see rising incomes across the globe over the next couple of decades, and that will have ramifications for the things like I just mentioned on producers of alcohol, or also producers of luxury goods like LVMH in Europe, or Heineken in Europe as well, the manufacturer of beer. So I think that's definitely a trend that's not going away, and I know it seems a bit kind of insensitive to mention that against the backdrop that we've had this year, where clearly real incomes have shrunk, but in the long run, that's not a trend that's going away. And the fourth one is one that's, people talk about it quite a lot, but it's to do with this idea of technology adoption and digitization. And COVID definitely changed things in terms of providing an acceleration of the adoption of technology globally. And it's not just thinking about things like Teams or Microsoft Teams or Zoom or something like that. It's also to do with the continued use of digital watches to monitor your health. It's also to do with things such as automation in our businesses. We're all using more automation, or businesses are increasingly using more AI in their business lines. So that's a trend that's not going to go away. And we read a report by McKinsey not so long ago that estimated that in Europe, COVID kind of increased the adoption of digitization and technology by around 3 to 5 years. But in certain parts of Asia, it's increased it by around 7 to 10 years. So that's a really exciting opportunity set. And if we take something like cloud storage, who are going to be the big winners of cloud storage? Well, currently you've got Microsoft with their Azure platform, you've got Google with their cloud platform, and you've also got Amazon with their Amazon Web Services platform. All of those are massive players in the kind of tech and cloud space. So quite exciting. They're obviously the incumbents, but we expect that there will be more that come through. And so that's why when we invest into some of the tech names or some of the US growthy names, we don't just identify the large cap names, we're also trying to get the winners of tomorrow rather than just the winners of today.
Okay, that's great, thank you. our investors will know that there's a mix of assets within these funds, shares, fixed interest, securities, bonds, etc. Has that mix changed due to the recent turmoils we've seen in the market?
Definitely. So a big bit of what we've been doing this year has been kind of equipping the portfolio for the new environment in which we're in, and that's meant for us this year owning a little bit more cash. Cash is, it's a robust asset. Clearly, you don't get a huge amount of return, but at the moment you get around 2% from our BlackRock cash fund, and yes, it's lost money in real terms, but in absolute terms, it's provided a positive return this year, which is good against the backdrop of almost everything else being down. The other thing that we've done is we've reduced our equity exposure, generally just taking that down against this backdrop of higher volatility. We've also reduced our fixed income exposure. So that's again reflective of this view that bonds were going to suffer throughout the year. So we reduced our fixed income, we reduced our equity, we increased our cash levels. And we've also been buying a fund in the space as what's known as absolute return. Now the idea is really for that absolute return fund, it's called the Rougher Diversified Return Fund, is that it can deliver a positive return in any one 12-month rolling period. It uses things such as bonds, but also gold, a selection of different style of equities that we might own in our own portfolio, like energy stocks. But it also owns things like it has a selection of derivatives. Now the derivatives have meant that it's been able to offset some of the losses in the fixed income side and the equity side of the portfolio by delivering structured returns. So that's done well year to date. It's around 3 or 4% up, which again, against the backdrop of most equities and bonds being down, is a very encouraging return.
Okay. One final question. We did ask you to polish up your crystal ball before you came in today. What does the next year, 2 years look like? Are we going to be okay?
In terms of being okay, of course, we'll always be okay. I think it's, every year is a year. If you look back over the last 20 or 30 years, every year there's something out there that kind of could derail markets or would be a good indicator as to why you should be de-risking and taking your portfolio out of markets. But if we just look at the last kind of 5-10 years, you've had Ebola, you've had COVID, you've had China-US trade war, you had Trump be elected, you had the UK mini budget, you've had crisis in Europe, Eurozone. There's been any number of reasons why you should be not invested. But if we take the US market, for example, which is of course where we are kind of majoritively invested, it is a money-making machine. In the long run, it goes up a lot, and year on year it continues to go up. Obviously, this year it hasn't, but over the long run, it goes up, and it goes up by a lot actually. So I think we have to kind of sometimes take our head away from what's going on in the day-to-day markets and look at some of these big trends that are at play. And we're really, really excited about some of the opportunities out there. I mentioned those mega trends that are at play, but I'm also excited about things like the current valuations in the bond space. For the first time since 2007, we can get some really attractive returns on certain bonds. If you take sovereign debt, i.e. government bonds, high quality, maturing in the next 1 or 2 years, you can get up to 4.5%. So you don't need to take much risk there to get 4.5%. Even our cash funds are giving us 2% or 3%. On the higher level risk in terms of bonds, high yield, 7-8%, depending on how much risk you take in terms of credit quality or maturity or duration. And then also, some good quality investment grade giving you 5 or 6%. So that's a completely different kind of spectre for us as investment managers. We've got now some quite compelling returns there. And then, of course, on the equity side, we're starting to see some quite attractive levels of valuation, whether that's in Asia or in Europe. We are a bit concerned about Europe in terms of the outlook, but valuations are getting to those levels where you have to start kind of recognizing that actually the forward-looking returns are going to be quite compelling again. So it's very hard to talk about the next 12 months. As you know, anything could happen in a 12-month period. Putin could declare some kind of ceasefire overnight. So much of it will be impacted by short-term forces, but we do take more of a kind of 3 to 5 year time approach, but we're very mindful of the short term, and certainly over the next 2 to 5 years, we think things are looking really attractive.
That's great. Reasons to be optimistic.
I hope so.
Henry, thank you very much for your time today.
Thank you.